take the time now to understand what your future might look like, because you might be able to take the time now to start contributing your money, your retirement savings, into alternative buckets, and that's called tax diversification. And that's to help keep more of your hard-earned savings with you versus giving it to the IRS in taxes.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Your Life, Your Money podcast, where we discuss thoughts, strategies, and actions to help you thrive in life, wealth, and retirement. I'm your host, Scott Searens, and in today's show, we're going to talk about financial fact or fiction, the old true or false, when it comes to subjects like your taxes, Social Security, and investments. Now, before we dive into that, I want you to think about this. Have you ever done a renovation? And at the end of the renovation, you recognize that you might have left something out. For instance, maybe you renovated your kitchen and you forgot about all those little handles that you had to put on the cabinet doors when you were done, or you put in a new deck or patio in the backyard, and then you forgot about maybe the flowers that you had to put around the exterior when the project was done. Well, why do I bring this up? Because sometimes those can mess up or break the budget that you had put together for that renovation. And I've talked about this many of times on the podcast, but there's a lot of things that can be easily forgotten when it comes to your retirement. And I quickly wanted to talk about this article from USA Today. The title of the article is, "These Retirement Expenses Could Bust Your Budget." Now, can you guess there's three of them. Can you guess what they might be? Like I had mentioned, easily forgotten. I continuously talk about them on the podcast, and so I want to go through them again, because if we hear things multiple times, then chances are most likely we will not forget. So again, an article from USA Today, "These retirement expenses could bust your budget." Here's one of them. One of them is healthcare. Now, the article states that an average 65-year-old couple can expect to spend $662,156 on medical bills in retirement. So when it comes to your retirement, have you thought about health care? Have you made it a part of your retirement income plan? Next on the list here, we have long-term care. Long-term care. The average, again, according to the article, the average 65-year-old, there's a 70% chance of needing long-term care support. What is long-term care? Well, as part of the natural aging and maturing process, we might need help. That could be needing help transferring from room to room, going to the bathroom, getting dressed, making our dinner. And so we might need help in regards to these activities. And Medicare is not long-term care. And the article goes on to talk about how the average senior spends $172,000 to cover their long-term care needs in retirement. And then the number one item on the list here, again, the retirement expenses that could bust your budget. The number one item on the list, which I continue to preach about, is taxes. And depending on, your total income, part of your Social Security might get taxed as well. I find that a lot of people are saving up in their IRAs, their 401ks, 403bs, 457s. And just remember, let's just say you have $500,000 or $1 million or $2 million or more in these types of accounts. All of this money is taxable. So if you have $1 million in your account, you don't actually own all of it. Part of that is going to go to the IRS in taxes, as well as even if you have a brokerage account, right? So the brokerage accounts, you're going to pay taxes on the recognized gains, dividends, and interest. And then depending on what state you live in, some states you have to pay taxes on your retirement income. Some of them have that where you have to pay on your retirement income. Some of them don't. So for all of these items, let's recap them. Taxes, healthcare, long-term care. Have you thought about these and made them part of your retirement plan? plan? Are they incorporated into your retirement income plan? Folks, there's a lot of times that we can get surprised, right? Like I talked about on a home renovation or maybe a small purchase where we get surprised at the end, but we have time to recover from it. These items here, what we're talking about is your retirement. You may no longer be working, so you might not then have the time to go back and save up for these items or recover from these items, meaning that you may then have to reduce your other spendable income, your lifestyle. So make sure to think about these items, make sure to put them into your plan so they don't bust your retirement budget and potentially ruin what you thought you were going to be able to spend and live on from a retirement lifestyle aspect. All right, let's move on here. Let's get into the financial fact or fiction. You know, sometimes the easiest way to learn about things is just to make it really simple. True or false. And so that's what I thought we'd do. I thought we'd take a few different subjects here and talk about whether they are financial fact or fiction. So here we go. The first one, fact or fiction. Your Social Security is taxable. Well, this is a fact, but it depends. Now, here's why it's a fact. Up to 85% of your Social Security can be taxable, meaning that it adds in to your taxable income. Here's what it's based off of. So as of today, 2021, an individual making between $25,000 and $34,000, so having $25,000 to $34,000 of taxable income, then you could pay tax on up to 50% of your Social Security. For that same individual, if you have $34,000 or more of taxable income, then you can pay a tax on up to 85% of your Social Security. And let's just say you're a married couple filing jointly, and you have between $32,000 and $44,000 of taxable income coming in, then up to 50% of your Social Security could be taxable. And then if you have $44,000 or more of, and I kept saying taxable income, but let's call this combined income, and I'll explain that here in a second. But if you have $44,000 or more of combined income, then up to 85% of your Social Security could be taxable. So what is combined income? Combined income is your adjusted gross income. Now, this could be your wages, IRA withdrawals, 401k withdrawals. Then you have to add into that your non-taxable interest, and then you need to add into that half of your Social Security benefit. So where all of that comes out to be, and that's where I'd say, hey, go talk to your tax professional to add those numbers up. But where all of that comes out to be, then you can go back to those brackets that I just provided to you to say, okay, will any of my Social Security be taxable? Will 50% of it be taxable? Or will 85% be taxable? Understanding this really helps also know when to claim Social Security. So let me just help you understand a few of the steps that we go through when working with clients. One of the steps is putting together a retirement income plan, and that helps you understand how much taxable or combined income that you would have coming in at each and every stage or year of your life. So that way you can also say, well, how much of my Social Security would be taxed? Now, some that are still working, but say, boy, now I've reached full retirement age, so I can collect Social Security, and I'm still working, so I can collect. I don't get penalized, or my Social Security doesn't get reduced because I'm working. So they think about taking Social Security, but you want to think about this portion of taxes, right? Because when you're still working and collecting Social Security, maybe more of your Social Security now becomes taxable, meaning more of your hard-earned money, right, is going back to the IRS because you decided to claim it while you are still working. So it may help, right, to wait until you retire or until you're no longer working to go ahead and claim Social Security. Or maybe if you're married and one spouse is still working while the other has retired, again, you want to look at this. You want to look at your taxable income, because claiming that second spouse's Social Security, the one that's retired, Well, you might just be giving a whole lot of it back in taxes to the IRS. So it may be in your best interest to wait to take that Social Security, delay taking it, letting it grow. Remember, each and every year that you delay taking it, your benefit is going to continue to increase until age 70. And at that point in time, we're not able to delay our Social Security benefits any longer, so we have to go ahead and take them. So just a little wrap up there. Is your Social Security taxable? Yes, it can be taxable, and it depends on how much combined income you have coming in. All right, let's move on to our next one here on the financial fact or fiction. Your taxes will be lower in retirement. This one is actually fiction. Well, reality is this one could be both. And let me just break this down into two different parts. The first part, tax rates. Where will tax rates be in the future? And that's an answer that really nobody knows. I mean, a lot of people believe that, hey, due to the national debt that we have, that there's nowhere for taxes to go but up in the future. However, as we've seen over the last few years, right, Congress actually passed a law, the Tax Cuts and Jobs Act, that virtually reduced tax rates for everyone across the board. So we really don't know what will happen with tax rates in the future. So the next part then that you really need to take a look at is, well, what would your taxable income look like in the future? And here's the thing. I think what we think about is, well, I'm no longer working at my job, so my taxable income, it's going to go down in retirement, right? Well, I really want you to understand one key thing, and it's called those required minimum distributions, those forced distributions that you have to take out of your IRAs, 401ks, 403bs, those qualified retirement plans starting at age 72. Now, in my practice, I work with a lot of savers, and it's those required minimum distributions that later in life can put you with the same amount of taxable income or potentially even more than where you're at today. And let me just give you a few examples here. I just ran some numbers so that way you could kind of understand required minimum distributions and what your future taxable income might look like. So let's just say that you've got $750,000 in an IRA and you're age 85. And you might be sitting there thinking, but I'm not 85 yet. Well, remember, average lifespans are getting longer, and let's say you live a long, healthy retirement. At some point in time, you might be age 85 and have to take required minimum distributions from that IRA, 401k, or 403b. So at age 85, a person with $750,000 or IRA would have to take a required minimum distribution of $50,676. Now, you might think, well, that's not too bad. That might be a little bit lower than where I was at when I was making income. But you also have to add into that, maybe you have pension income coming in. Maybe you have rental income coming in. Maybe you have Social Security coming in. Maybe you're married, and so your spouse has Social Security income coming in. So next thing you know, your $50,000 required minimum distribution is now on top of other income that you have coming in. And next thing you know, you might have $100,000 in total income coming in, or taxable income coming in. And then you have to look and say, well, where is that compared to where you're at today? The other thing to be aware of when it comes to required minimum distributions is the rate that you need to withdraw from your IRAs and 401ks. The rate of these distributions, that rate goes up or climbs over time, meaning the IRS over time is basically forcing you to take more money out. They increase that rate at which you need to make withdrawals. And why is that? Well, of course, you've been deferring taxes on all this money for a long, long time, so they want their cut of taxes on your money. So let's just say again, same person, $750,000 in their account, and now they're age 90. So at age 85, it was $50,676. Let's just say, based on how they were invested, they were able to maintain principal in their account through age 90. That same $750,000, you're now taking a withdrawal of $65,789. That's basically a $15,000 increase in a withdrawal that you now need to take from your account. Let's just move this up a little bit. Let's just say there was $1 million in the account. At age 85, that would be a $67,568 withdrawal. At age 90, that could be an $87,719 withdrawal. Let's move this up. If you had $2 million in the account, age 85, $135,135 withdrawal. And at age 90, that $2 million account, you could be making a $175,438 withdrawal. And like I said, don't forget to add into that pensions, rental income, Social Security. And you can see how quickly your future taxable income could be the same or potentially more than you're at today. So let me just walk you through a quick story. A client that is actually in his mid-70s, when we sat down, and part of the process that we go through with clients is putting together a tax projection as well as their retirement income plan. And we sat down and looked at their retirement income projection and their tax projection. The first thing that this gentleman said to me was, I wish I would have done something 5 years ago. Why do I bring that up to you? Folks, tax planning is so important. Investments, right? Investments can be a matter of opinion, but taxes are a matter of fact. And so it's so important that you take the time to project out your future. So that way you're not going, boy, I wish I would have done this 5 years ago. I wish I would have done this 10 years ago. I wish I would have done this 15 years ago. Instead, take the time now to understand what your future might look like, because you might be able to take the time now to start contributing your money, your retirement savings, into alternative buckets. And that's called tax diversification. And that's to help keep more of your hard-earned savings with you versus giving it to the IRS in taxes. All right, what's next on our list here? Next on our list, financial fact or fiction. Term life insurance is better than whole life insurance. Well, my personal opinion when it comes to this is that this is a fact. So you really need to ask yourself, what is life insurance for? And life insurance provides a death benefit so that in the event that something were to happen to you, your beneficiaries can continue to maintain their lifestyle. They can continue to pay off maybe any sort of debts that you were helping them pay off. They can continue to go on and do the things that they need to do after the loss of your income. And so why do I bring this up? Because a lot of times the whole life insurance, right, is pitched, I'll use that word, it's pitched as an investment. And you have to remember that life insurance, there is a cost of insurance. There's a cost to having that death benefit. There's a cost to having that policy. And as we continue to mature and our age goes up, so does the cost of insurance in these different policies. So my personal opinion is to use life insurance for what it's for, right? In the event something were to happen, it provides a death benefit. Use investments for growing your money. Use savings for savings. You know, if you need retirement savings, focus on the investments, or maybe you're going to use real estate, or use something that, right, is going to provide you a proper return on your investments. Now, there's a but, and there's a however here. There are some hybrid policies out there, that life insurance policies, that might make sense because, and when I say hybrid, they're also providing a long-term care type benefit. And maybe that's important to you, like from a long-term care standpoint. You didn't like the traditional use it or lose it long-term care policies. So some of the hybrid life insurance policies that build cash value also would provide some sort of long-term care protection to you. Then there are some cases where if you have maybe a higher income or a higher net worth, that you do want to potentially look into life insurance as there are some taxable benefits to building cash value in life insurance, but it's really a strategic approach, and it's really not necessarily meant for everyone. And like I said before, there is a cost to the insurance, so you have to kind of weigh out what those benefits would be from using it as a tool to build cash value versus just going and utilizing an investment account, right, an IRA, 401k, or a brokerage account. All right, we've got a couple more left here. The next financial fact or fiction is Medicare will cover your medical needs in retirement. Boy, this is right back to our original discussion, right, on the top 3 items that could really bust your budget in retirement, and one of them was healthcare. So how about this? Medicare is going to cover all of your medical needs in retirement. This one is fiction. You know, as I mentioned earlier, the average 65-year-old couple can expect to spend $662,156 on medical bills in retirement. That's a big number. Have you thought about that? When it comes to Medicare, you've got Part B, which is outpatient services, and you pay a monthly premium for that. And then we've got Part D, which is prescriptions, and you also pay a monthly premium for that. But right, Medicare is not going to pay for one of the items I was just talking about, long-term care, right? Medicare is not long-term care support or long-term care coverage. And from a home health care standpoint, you could be looking at, in the event that you were to need it, you could be looking anywhere in the range of $50,000 to $60,000 or more. Could be more, could be less. And then if you were to need to go into a nursing home, you could be looking at $90,000 to $120,000 a year. Again, could be more, could be less, depends on where you live. But Medicare is not covering those bills. And with over 70% of people needing some sort of long-term care support, it's really important that you think about this. How, in the event that you are going to need long-term care, how are you going to cover it? How are you going to make sure that you get the care that you need? How are you going to make sure that in the event that you're a married couple, that you each get the protection that you need, that the first spouse doesn't go through all of the assets, leaving the remaining spouse with little or nothing to live their life? And then last is, how do you, if you want to pass on a legacy, how do you make sure that you've protected your assets to help pass them on to your family, to your beneficiaries, to whomever means the most to you? So wrapping up on this one, Medicare will not cover all of your medical needs in retirement. Make sure that you're, again, as you put together that budget, don't let healthcare be a budget buster for your retirement. All right, so here we go. Our last financial fact or fiction. As you get older, you should gradually shift from stocks to bonds. And I'm going to say this is a financial fact, in my opinion, but you need to be cautious, because I find that a lot of people can get overly conservative as they go into retirement. So let's just first understand one thing in regards to where you're at in life. And you have to understand, are you in the accumulation phase or in the decumulation phase, right? So the accumulation phase is where maybe you're working, you've got income coming in, and you are able to save and invest. So as the market goes up and it goes down and it goes up and it goes down, you are able to continue to save and invest. However, there's going to become a point in time where you move into the decumulation phase, right? And now that's where maybe you're no longer working. And so all of your retirement savings now becomes your new company, right? No longer have a company, but your retirement savings, right? Everything that you've saved up, that becomes your new company, and you now have to cut your own personal paychecks. So during this phase of cutting your own personal paychecks, your recovery time, if the market were to go down, is a lot different than when you were still working, when you were saving and investing. So if you're at too much risk, it could really devastate what your long-term withdrawal amounts could be. Think about this. Imagine life. Imagine your retirement as a driving trip. And for that driving trip, you have to pick the right engine for your car. And let's just say, because going back, right, as you get older, should you gradually shift from stocks to bonds? So let's just say in your car, you were to pick this drag car engine. Well, if you're in the accumulation phase, and what can happen with a drag car engine, right? A drag car engine, boy, you put that pedal down, I mean, it's going to move fast, but can it last, right? If you're going from the East Coast to the West Coast with this drag car engine, be able to last that long? I'm not sure if you've seen some of the videos, right? But these drag car engines can blow up just in the short sprint distance that they do in the races. Now, if you're in the accumulation phase, right, you might have time to save, invest more, recover, fix that engine, and get back going again. However, if you're in the decumulation phase, you might not have time to watch this drag car engine blow up. Now, what's the opposite of this? Well, you wouldn't go and drive on your trip, let's say from the East Coast to the West Coast, and put a lawnmower engine in your car, right? Because you'll never get there. It's going to take way too long. It's going to move way too slow. And so it's finding the right balance, finding the right engine to help drive your funds and your retirement. Now, part of the process that we go through with clients and that you want to think about is putting together the balance in your investment portfolio is putting together a retirement income plan. Because here's the deal. I find a lot of people out there are preaching the rule of 100. And I don't believe in the rule of 100. But here it is, just so you know, right? It's saying that you take your age, and your age is how much you should have in bonds. And then you take 100 minus your age. So if you're 60, 100 minus 60, you should have 60% in bonds, 40% in stocks. Folks, I think that makes folks way too conservative because you have to think about inflation. You have to think about making your money last for 20, 30 years or longer. And so instead of the rule of 100, part of the process that we go through with clients is helping them build the retirement income plan. How much are you going to need in the next 3 years, 5 years, 7 years? Let's make sure that we have that on the safer side of your portfolio. So in the event that there is this blow up in the stock market, you've now got the safer side of your portfolio to go to live your lifestyle as the growth side, the equity side of your portfolio continues to recover from whatever happened in the market. So fact or fiction, as you get older, should you gradually shift from stocks to bonds? Yes, in my opinion, yes, you should, but don't get overly conservative in your approach. Now, you might be looking at me or hearing this and going, Scott, but I just don't like all of that risk. And you know what? That's fine too. You have to find an approach that works for you. Just understand that the more conservative that you go, you might also then have to reduce how much income that you're withdrawing from your portfolio. Folks, I hope that you've really found this to be of value and benefit to you. And if so, and you'd like to hear additional podcasts just like this to help you build wealth and reduce your long-term tax picture, subscribe to the podcast. You can also go to lifemoneyshow.com. That's lifemoneyshow.com. We've got plenty of podcasts, videos, great content there to help you in your financial future. I really look forward to our next conversation to continue to help you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.